So, kind of moving on to this RealPage report, and then I want to move on to single-family housing. Pricing weakness continues in South and West regional markets. I'm looking at the markets with the deepest rent cuts. Year ending October 2025. And again, Jay and I, Great Capital, we're active in the Midwest and Indiana, Ohio, Kentucky, Michigan, where we've seen positive rent growth. Some flat at some properties, but generally positive. Not a lot of deeply negative rent growth, and it's still hard to pencil deals. I don't know how you pro forma something and buy something and underwrite it when you have negative rent growth with negative rent growth forecasted for future years and significant amount of supply still coming online. So, the market with the deepest rent cuts right now in 2025, it's not Austin. It's actually Denver, Colorado, with minus 8.1% annual effective rent change. My gosh, annual supply by the third quarter is 14,000, and that's only a 4.1% annual inventory growth. That's actually not that large. It's kind of moderate, but they're still absorbing all of the inventory that was delivered, this last year and in 2024. And it's that overhang that is extending the process, and call it pain or whatever you want to call it, when I think there were a lot of investors out there that were like, survive until 2025, the supply is going to fall off a cliff and then rents are going to spike. But it just doesn't happen that quickly.
Yeah, and I think, we even thought it here. We looked at the deliveries, and we've seen the deliveries slow down here.
Sure, yeah.
But I do think it's probably going to take 12 to 18 months longer on that equilibrium that we're looking at. On a lease up, the hardest part on a lease up is for agencies to even look at it. It's got to be 85%.
Yeah.
But that doesn't mean they'll give you debt at 85%, but they're not going to be full leverage at 85%.
No.
And that's, I think, where the dichotomy with a lot of these is these are going to be stuck at 85, 90% for, call it 12 to 18 months, when to get the full leverage and the value for the proposition for a buyer, they need to be higher. And that's, I think, where the real rub is right now, is they're going to be cutting these rents to get to that area where they can get some sort of exit. And that's where I see kind of the friction in the market right now is, people will lease up a lot of different stuff. I see not saying there's none, but I see very little that's sitting at 60%.
Yeah.
But I see a lot sitting in that 80 to 90% range.
Well, going back to, again, occupancy and demand, clearly there's demand. There's units being leased. There's at lower rates, and occupancy, while is lower in many markets, it's up year over year. So units are being filled. They're just being filled slower and at rates that are lower than what was originally anticipated. I'm looking at apartment rent growth leaders year ending in October 2025. San Francisco is taking this top spot. We've talked about that multiple times. And as Jay and I were discussing before we press record, a lot of that is still a recovery from COVID. And I saw a report this morning that rents in San Francisco are essentially flat based on 2019 levels. They really didn't experience any growth during COVID, where Austin has seen declines, and it's probably getting close to being flat, but moving the opposite direction. After it experienced 30% rent growth, now it's had multiple years of negative 8 or 10% growth. Markets in the Midwest typically had less rent growth than Austin, but still double digit, but then never saw any declines. Have just been continuing to compound. And out there, New York, in that similar category as San Francisco, although the recovery took place in New York earlier than San Francisco and has been a little bit more stable. Then we've got a lot of other markets, in the Midwest.
I'd say all those top four are probably all in the same boat.
Yeah, I would say I would agree. San Francisco, San Jose, New York, and Chicago. Chicago would be one that I think has slightly different dynamics, given the so little supply that's adding to Chicago. Annual inventory growth as of the third quarter in Chicago is 0.4%. Now, San Francisco, similar levels, 0.6%. But comparing to, again, when we compare it to markets like, Denver or Austin, Denver's 4.1, Austin's 6.4, but markets like Charlotte are still at 7.3%. Phoenix is at 6.1% annual inventory growth, and it's seeing negative annual effective rent changes of negative 6%. And so, Chicago, which, this is really driven by, political uncertainty and, property taxes in Cook County. There's an interesting argument being made of Chicago as a very attractive market. It's pretty contentious here, even at Great Capital, because Chicago's 3 hours away from us in Indianapolis, and the fundamentals are pretty strong. We know of a group that's buying a deal in Chicago. It's really expensive, like price per unit, but the cap rate seems really attractive. It looks like it's probably going to be a pretty good deal. I don't know all the details, but looks like they're getting a good deal on it. There's a lot of things to like about Chicago. It's just that politics can just wipe your returns out, with a stroke of a pen.
Yeah, and I think that it's the unknown. And I mean, obviously, you have some of the especially the west suburbs there that people are like, okay, you can kind of pencil that in, but it's like, at what point does the bleeding from Cook County bleed out into the suburbs? It's never going to be a 1-for-1, and it's like, there are a lot of people in Chicago, a lot of really smart financial people in Chicago. And if they're maybe not bullish on it, what makes us think we're going to come from Indianapolis up there and fix their problem?
I think some are. I think some are, some aren't. I think, some, are so burned by the political system that they're not, but others are like, yeah, whatever, we can navigate it. And I know somebody, and it's what we know. Clearly there's some people that are still trying to make a run for it.